Thanks for joining, Matt. I appreciate it. This is a new video series that we're starting here just to, get connected and share insights that we have with those that, operate in the space. Obviously you represent a fair amount of lenders out there. Love to get an intro on yourself in just a moment. But, the goal here is, talk through what we're seeing in the market and, what we might think will be around the corner. And hopefully someone watching this will find at least one thing that we say here useful that they can use themselves. But
all right.
Yeah, so I'll hand it off to you to get started with a quick intro. If you don't mind telling us a little bit about who you are, what you do, your firm, and so on.
Yeah, absolutely. So I'm Matt Schwartz. I'm the U.S. Finance Practice Group leader for our U.S. Finance Group. We cover a whole bunch of different range of finance transactions, from venture debt to leverage finance, structured finance, projects and energy, sports media and entertainment, restructuring. Pretty much anything having to do with the capital provision to companies that's outside of the venture capital and private equity world. My personal practice is representing lenders, banks, and private credit funds. I've been doing that for 20 plus years. The main focus is on companies in the technology, life sciences, and healthcare space, although I've done all different kinds of companies, anything that doesn't have to do with real property, any sort of financing mechanics, whether it's debt, hybrid debt and equity, convertible notes. Over the years, I've done restructuring financings. Basically, anytime anyone's lending somebody money, that's kind of our world.
Okay, makes sense. So you've seen a thing or two. Where do you focus between banks and private credit? What would you say the balance is of the different clients that you work with?
Yeah, I mean, our group's kind of a 50-50 split. I would say it's by the numbers, probably, we probably do more bank deals because some of those deals tend to be smaller, especially in the venture debt side, whereas the private credit deals tend to be larger, more complicated. But by hours, it's probably 50-50 in terms of the time that our team spends on both. I would say, me personally, I've been spending more time in the private credit world lately, simply because it's been on the rise. Although in the last year, there've been a bunch of new bank entrants into the space as well. So it's kind of just a balance between the two. Based on the day, the week, the month. It's really a 50-50 split within our group.
So I guess that's if it's a balanced split, you must see obviously different appetites with risk appetites and behaviors and so on. What are you generally seeing between the two? Behaviors, trends, where they're getting a little bit more aggressive than they might have been, or a little bit more conservative, more likely in other areas.
Yeah, absolutely. I mean, I think different banks and different funds are aggressive or conservative in different areas. Obviously, banks have many ways they can make money with a relationship, including cash management, making money off deposits, credit cards as a feeder for their investment bank. So, in terms of the debt product itself, you'll probably see a more conservative set from the banks as a whole, whereas private credit funds only make money off of the debt or the equity that they get in connection with the debt. So they have to be more aggressive simply by their nature. Obviously banks too, their funding sources mostly are from deposits that they take from other depository customers. They have to be more conservative with those deposits, whereas a private credit fund may have LPs who wish to be more aggressive in terms of going after returns. So I think by their very nature, private credit funds tend to be more aggressive and have more flexibility, although you are seeing lots of banks in the space getting aggressive on terms, including lower pricing, lower fees, lower warrant coverage. So I think it's really it really depends on who it is and what their motivation is within the industry.
Yeah, we're seeing a lot of that right now. Excuse me, where I'm sure you might have noticed this too. Obviously, 2020, 2021, even the very beginning of 22, it was all equity and banks. Everyone, people were lending like crazy. People were writing checks like crazy on the equity side. We had actually a lot of companies obviously pushing back on some of the private credit stuff because they're like, well, why am I going to pay 10, 11, 12% back then for private credit when a bank's charging, 3%. What we saw as banks started pulling back a little bit more due to the equity markets drying up. Obviously, the private credit guys got super aggressive. So I don't know about you. I haven't seen a ton of changes in risk appetites on the private credit side. Maybe some of the fringe deals that they might have done just to get a couple transactions done a few years ago. They're not doing those anymore, but we're seeing appetite on the private credit side relatively the same, if not more aggressive in some areas.
Yeah, no, I mean, in terms of the risk appetite, I don't know that that's changed much. In terms of the pricing or the flexibility or the willingness to do non-covenanted deals, no amortization deals, deals with lower fees or lower warrants, there seems to be more optionality out there on the upper end, and then on the lower end, we've seen, when I say lower end, I mean in terms of sizing of deals and stage of companies. There are funds that have come into the market who are doing million or sub-$1 million deals, $1 million, $2 million, $3 million deals that used to be, bank deals all day. And people or companies are sometimes going to private credit funds to go do those deals, at similar kind of terms to what banks were doing not that long ago, albeit higher pricing. So even though the actual risk may not have changed, the same risk deal may be getting done at more expensively now. Now, part of that is due because interest rates have just gone up. So the pricing overall has gone up, and therefore the delta, even though the delta between the bank deal and the private credit deal hasn't changed, the aggregate, when you look at all the all-in pricing, it feels like the difference between a 9% private credit deal and a 5% bank deal, that feels more than a 13% private credit deal and a 9% bank deal. It feels like a bigger difference, even though it's the same 4 percentage points.
Yeah, so most of the deals we're doing are in that $5 to $25 million range. So, obviously, dollar wise, it's a much smaller difference than when you have a $100 million plus transaction. Percentage point makes a big difference on that monthly payment. But yeah, we were working on a deal last year. It was there was a private firm or a private credit offer on the table for, I think it was 40% larger deal. Only one very relaxed covenant on revenue retention. That was it, which the company was not even going to come close to unless they were falling apart. And the bank offer was much smaller, much cheaper to an extent, but it came with a bunch of hooks. I think it was so it was a $7 million bank deal, but they had to keep $4 million in liquidity. And, the bank's like, well, you have to understand the price difference. I'm like, I do. There actually isn't that big of a difference because the bank offer was 8.7% or something like that. And the private fund at the time was 13, but they were getting way more money and they could operate a lot freely. And the company was like, well, we're going to have to raise equity to stay in compliance with the bank deal. So we're definitely seeing the private credit be more attractive for companies because, they're seeing it as a true equity alternative where it used to be, well, I can boost my valuation 50% or 100% on the company, get cheap bank working capital, or I don't have to do any of that and just do private credit at a higher rate. But net, it's going to be a lot more effective for us long term.
Yeah, look, right now, optionality and flexibility seem to be worth more than they were worth 24 months ago. Having a longer runway, giving yourself a longer time for the markets to get back to some sort of normal condition, having an amortization be further out in the future. That optionality seems to be worth more to companies now than it may have been worth before.
Yeah, the first question I always got asked whenever we got term sheets for clients. Now, we always preview with them, this is what we're going to find. But the first question we'd always get asked, why is this so expensive? This was in 2021. It's because it'd be, 10 to 12% typically. And I'm like, well, I explained the mechanics of a private credit deal. Right, but rates are at zero. And you're not borrowing from those guys. You're borrowing from the private credit. But now we're not hearing that at all. They don't get, I'd say early part of last year, there was definitely sticker shock with rates going up as quickly as they did. But we don't hear anything about pricing at this point. Rate used to be the first thing everyone wanted to hack away at. Now it's covenants, IO periods, extended runway, things like that. They're not so concerned about pricing because obviously no matter how you look at it, it's cheaper than raising equity.
Yeah, and I think the free availability of equity 2 years ago is starkly different than the market is right now. The prospect of raising at a flat or a down round and diluting your existing investors, that seems more daunting than perhaps paying a bit more for a flexible financing solution.
Yep. Yeah. I always tell different lenders, we send out a quarterly lender report every quarter. And the number one thing, because we always get asked, or we got asked when we first started, like, hey, can you let us know what wins a deal? And we always include, like, we started compiling data on who was winning deals, and it was always the first group to be responsive. So actually dive in on the package, and it was the most flexibility. It was very rarely the cost. I'd say more often than not, clients that we've worked with have gone with the either a larger deal or more flexible deal, whatever that might mean for them, not the lowest cost. Lowest cost doesn't always mean the best value that we found.
Yeah, no, I mean, that's definitely, I think, where the market is at right now. People are looking for the most optionality they possibly can. Thank you.
So what have you seen? I can share what I've seen afterward from a client perspective, but from a lender side, what are you seeing where they're really digging in their heels on terms where, anything in particular now that might be different than before, as far as, you're talking about maybe some lenders aren't doing as long of IO periods or light deals or non-covenant deals. Anything where you're seeing they're really digging in?
Yeah, I mean, I think pricing is one of them, where you have to get certain pricing on a deal to make it worth it. Whereas the era of cheap money is probably over. That's one. Structure, not necessarily on financial covenants, but on the more operating covenants, like permitted liens, permitted investments, permitted acquisitions. I think lenders are really digging in more where there used to be much more flexible baskets for smaller companies. They really want those baskets to align with a reasonable expectation for what the company is going to do, as opposed to like, hey, we might do this, unless it's going to be, this is in the plan, it's in the budget. I'm not seeing as much permission for that sort of thing these days. Really digging in more to operating projections, to cash burn, to looking at expenses and what those expenses are and how necessary they are for the company. I think that we're in an age where there's more diligence being done on business plans than was before. And that's not necessarily an inflexibility. It's more of a reflection of reality that companies need to be a lot more careful right now than they have in the past, simply because equity is harder to raise than it was before. The other thing that I'm seeing too, and it's not really an inflexibility, but there are more what I'll call distressed M&A type opportunities available, or opportunistic M&A opportunities available. So if a company thinks that a competitor, perhaps is having trouble fundraising, they may look to be opportunistic and acquire businesses, roll up businesses together. So it's not quite a restriction, but we're seeing more of these like acquisition type facilities where acquisitions are being financed, even if that acquisition is being, even if debt's being used as the acquisition vehicle, there's money coming in to help operate the combined companies. So I think it's more of just a realistic drilling down into the operations of the business than we had seen before. Some of the other things are like monthly versus quarterly financials, more updates, monthly board packages versus quarterly, more 13-week roll forward cash flow projections more frequently. So more frequent reporting, more board observer rights in terms of the lender observing the activities of the board than perhaps we've seen before. It's not that we weren't seeing those things. They just seem to be more common and less controversial, more understood by the companies that like, hey, lenders are going to have more frequent interaction with your finance team and your operations team than they may have had in the past.
Yeah, I think that makes sense. And to your earlier point, that about inflexibility, it's not inflexibility, but we always coin it as like guardrails with the clients. Hey, what these seem like tough terms. Like, and my first question is, how applicable are these to you guys? Like, well, you never know. And I'm like, well, if you don't know, they don't know either.
Yes.
We worked on a deal a little bit ago, and they're a profitable business, which we are seeing more of those right now, either very close to profitability or at profitability especially on the tech side. And their first question is, well, can we have a little bit more flexibility on a burn or something? And one of the term sheets we got, they really liked the deal, and it had a requirement for a very modest amount of burn throughout the year. But the company was planning, like, I think it was like $7-8 million in EBITDA positivity. So they allowed, I think, a burn of like $1 million, because they're like, that's a $7 million swing. And the CFO obviously making sure that they have plenty of buffer room, went through all these scenarios and asked for a $4.5 million burn allowance. And I'm like, do you know how hard it is to get a lender? That's a huge swing from $7 million in profitability. That's an $11 million miss to plan. And the lender, he made it clear. He's like, look, I don't mind if they do that. If they want to raise some money, if things are working out, we can restructure things. But on this plan, he's like, I can't get committee to agree to just throw out a random change for no reason. And he's like, show me that plan. And, a couple of years ago, everyone was like, yeah, sure, why not? You can go raise money. You can sell this thing very quickly. And, like you said, companies have to be more careful. Lenders are being more careful. Investors are being more careful, which I think we started to see stronger company profiles. It's not the 60% growth every year minimum. It's 20 to 30% annual growth, but it's responsible. It's profitable, sometimes at the very least break even. And, the debt side of things is either just to strengthen the balance sheet or to just more responsibly invest in growth.
Yeah, absolutely. And I think you just have to be more realistic and more the range of possibilities. The debt facilities account for a smaller range of possibilities than perhaps they did before. We're more focused in the range of probability rather than possibility, if that's the case.
Yeah, one of the
we're looking at the debt documents these days are addressing the probable, not necessarily the possible.
Exactly.
And if we get to a point where the possible becomes the probable, we kind of come back to the table.
Yeah. And I think one of the things that, especially companies that haven't gone through the process before, or even worse, have negative experiences with lenders, you always hear, you're raised to stay away from debt. Don't take on credit card debt. Don't take on unnecessary debt. But in the business sense, it's obviously a lot different. Debt is a very useful tool to finance your business. And, we always have clients, especially when they're first getting into the debt space, it might be their first debt transaction. They read the terms like, these are tough. Like these are really difficult. I'm like, yeah, that they kind of have to be. But I think what they don't really understand until they obviously experience the first time is lenders are very relationship oriented, especially on the private credit side. We've always seen that because, it takes one bad behavior by a private credit group to have that get around, and all of a sudden no one wants to deal with them anymore. So we always have to educate people, like there's a little bit of give and take. They're going to assume your plan might be a little bit different. You might operate a little bit differently than you say. That's okay. They're going to work with you. You have to trust them as well as a capital partner that they're going to behave in good faith.
Yeah, absolutely. It's a very relationship-based business. And, we're seeing that more and more these days, that you're right. If a lender does something that's perceived to be unfair or too aggressive, that can hurt their chances of winning new business in the future.
Yeah, I think people don't realize how small of a world it actually can be. We saw this a lot during COVID, where we were working with companies that were looking at different financing options and talking to all these lenders as they were sifting through everything. I don't think I talked to one lender that didn't have to reset covenants with their portfolio. Yep. They didn't have to do something because, who saw that coming? Whereas I think in the back of everyone's mind, they're like, well, lender's just going to call their capital back. And that's not necessarily how it works, especially in the private credit side.
Yeah, most of these deals, 99% of them get reworked. And in fact, we've seen an enormous amount of refinancing. I call it amend and pretend. We're kind of kick the can down the road. That most lenders don't want to own the businesses of their borrowers. Period. That is the last resort. The goal is to find a way to make it work. And I think that when you keep that in mind, 99+% of the deals I've worked on in my 20-year career have successfully exited with either a refinance or payoff or an M&A activity or public activity. Very, very, very small percentage of them end up with the lender actually exercising the remedies and selling the business. Very, very small. Less than 1%. Even less than 0.5%. That's a corner case where that happens. That is truly the last resort. The lender has the right to do that, but we tend to not work with sort of the vulture lenders. There are lenders that are looking to do that. We tend to not work with them in our group. That's just not our preference. They are out there, but they're few and far between, and they kind of tell you up front, that's their goal. So, when someone's working with us and one of our lender clients, they can safely assume that the goal is to get everybody to a smooth landing, no matter how that landing comes to be.
Yeah, because I mean, I don't think people really realize all the steps and time that go into any type of default foreclosure situation. It's such a headache for everyone. I mean, the companies think that,
Yep.
I think that a lot of companies are like, well, the bank just has to file a form. It's like, no, they have to, there's a lot of
No.
work involved. We worked on a deal last year. They came across us actually, and they called us 2 weeks before their 6 month forbearance agreement expired. And they weren't in the best spot. I think the lender, it took the company about 4 months to decide to hire us because they kept wanting to try to do it themselves in the refinancing. And the lender, I think, signed 4 or 5 extensions because he's like, look, it's just not worth it. They're paying their bills. But he's like, I prefer to get paid off sooner than later. But, to your earlier point, it is relationship oriented. He's like, if I send these guys into foreclosure, one, I don't want to own this business. I don't know how to run it. I'll definitely lose all my money. But two, he's like, how many groups are going to want to work with me again if I'm known for foreclosing on businesses that are actively working with me?
Well, and I'll tell you, I've worked on deals, including one this year. I won't say who or what, but it was in the news, and the lender sort of got blamed at the end. They kind of got, I don't want to say bad press, but we're kind of like, they were basically forced to shut the company down. And I know for a fact that the lender tried their absolute hardest multiple times to give the company a parachute that would work, to find an acquirer, to come to a mutually consensual arrangement. And at the end of the day, they were basically given no choice but to, hey, here are the keys, go do what you need to do. And even in that scenario, the lender was painted as the bad actor, when I know for a fact that they bent over backwards and tried to do everything that they could try to do to give the company a smooth exit. So that to me is a great data point for really how hard lenders, the ones that we work with at least, tend to try to make things work.
Yeah, we'll get asked probably every third or fourth deal they're working on. Hey, what happens in a default situation? What happens here, here, and here? I kind of give general responses because I find they're all pretty much the same that all the lenders give it. Look, something happens. We're going to call you and ask what's going on. We prefer if you give us a heads up, but we're going to call you and ask you what's going on. If you don't answer our first call, we're going to email you. If you don't answer our email, we'll email you again just to check in. After several weeks of not hearing from you, then we're going to start getting concerned. We're going to, start sending you some notices. And then at that point, we're going to keep trying to get a hold of you. And it ends up being like a 6-month process until, they actually end up getting into the legal side of things. And, what I always tell a company is just answer their phone calls. All you have to do is, it's that easy.
Absolutely.
Yeah. My favorite is when companies ask, what if we just don't pay our bills? Like, well, don't take on the debt if you can't pay your bills. But even still, it's like, just answer their phone call. That's all you have to do. Give them a heads up. You're hitting this bump in the road. We got this, and this. I don't think people realize, especially on the private credit side, and there's more educational content coming out about it. Lenders can't afford to write off an investment like an equity fund can. An equity investment, it's not uncommon to double, triple, and quadruple your money on one investment. Lenders aren't doing that. So you're not offsetting the losses somewhere else. So, you said the lender did everything they could. I mean, lenders really have to do everything they could. And the only times 100%. We've ever heard, a lender, a deal that we did down the road falling apart is it was always the same. VC did this, and this. Private equity came in, they did this. They decided they weren't going to pay us anymore. They wrote off the investment because the company wasn't performing. And it's almost never the lender.
Correct.
Yep.
100%.
But we're at the end of Q1 here in 24. We got 9 months left in the year. Seems like things are picking up. I mean, private credit was obviously busy last year. There was a lot of activity last year, good or bad. We just saw some IPOs come out this week. What are you hearing on your side as far as what the next 9 months might look like?
Yeah, so I think there's going to be a big uptick in venture financing and in the M&A world in the public markets. I do think people are waiting for the Fed to cut interest rates. I think when that happens, that will be a great signal to the market that it's time to dive back in. There's been an enormous amount of refinancing activity out there on the debt side. There's been a bunch of new deals, old deals getting recycled. Obviously, there are a bunch of new entrants in the market, both on the private credit side and on the banking side. The debt market right now is pretty hot. It's as hot as it's been. This quarter was definitely the busiest quarter we've had in probably 5 or 6 quarters, with a lot more deal activity on the horizon. There are obviously certain sectors that are hotter than others. Right now, fintech is very hot. Energy is very hot. Healthcare, health-enabled services, B2B software is pretty hot. We're starting to see the cracks in biotech starting to come back a little bit. Medical device is a space where we're starting to see, things coming back. Straight tech has been challenging on the big side, but we're starting to see some bigger financings. Things are all trending in the right direction. It would be really nice to see some troubled M&A and some smaller VC rounds, some nice juicy Bs, in the $50 to $100 million range. We've seen earlier stage financings, later stage financings. It still seems like in that middle, it's a little bit soft, but I do think as the year goes on, we are on the right trend. Interest rates, we keep hearing that there's going to be interest rate cuts. It's obviously an election year, so there'll be some sort of, instability with that. But I do think in general, there is a view in the market that things are on the up and up, that we'll see, more activity, and that should definitely help companies who are looking either for new debt facilities, for refinancing activity, to raise capital, to have exits, both in the public markets and in the private markets. So, I have a relatively rosy view of 24 heading into 25 in terms of, I think it'll be a slow and steady rise back to, I don't know that we're going to get to 21, 22 levels this year, but I do think it's that we're in for a relatively healthy year in the transactional markets in that space.
Yeah, we've heard a lot of similar takes. I mean, whether they're private equity, VC, M&A advisors, what have you, companies. One thing that'll be cool to see, because I remember reading about some of these exits. Like, there were some companies that we would talk to, they weren't quite a fit, or they weren't raising at the time. We're just having a conversation. They kind of give me their financial snapshot, and 3 months later get acquired for astronomical amounts of money. I'm like,
yep.
How? Why? Like,
Yeah.
I saw their numbers. One thing I think will be really cool is you're going to have stronger companies, like I was talking about earlier, where they might not be growing, but they're not burning ridiculously. They're more sustainable. And I think that'll help fuel, like you said, a more steady rise, because you don't want what happened in 21 where it just goes bananas again. But I think it'll be good to see, healthier companies get acquired. And that's what we're hearing from a lot of companies who have VCs and private equity guys on their board, where they're like, look, stay stable, get to the point where you could be profitable if you wanted to, raise a little bit of debt to fuel some more growth if you want. But, 12 months from now, I think we're going to have a pretty robust M&A market again. And, perhaps hopefully the return to the IPO side of things, because I think 1, maybe 2 interest rate cuts through this year, because I know they're projecting 3. I think that first or second one is really going to be the green light for a lot of people.
I agree with you. It'll be a strong signal to the market. Yep.
But well, look, I appreciate the time here. Any closing thoughts or anything like that before we wrap up?
Yeah, it's thank you for having me. It's my pleasure. Yeah. I mean, I think, closing thoughts are, we're in an interesting time in the space. Companies should be thoughtful and careful about how they manage their funds. More than ever, I think they're looking at debt as a useful tool. There are many, many options out there. I think being wise about who they choose to partner with, what their needs are, is more important than ever. Using experts like you guys to figure out who the right partner is, doing your research, getting a bunch of different term sheets, being smart about the counsel that they choose to use, being smart about the counsel that they ask their lenders to use, more important than ever, because you are at a place where you want to try to minimize transaction costs and maximize the value that you get out of these transactions. And, I think we're in an environment where everybody is really focused on the art of the probable and focusing on what is likely to be successful. and maybe filtering out both the corner cases on the high end and the low end, and focusing on that kind of juicy middle of what's likely to happen, where are the most likely outcomes. I think that using your smarts in this environment, not dreaming too big and not looking too small, is probably the right mindset for success in this environment.
Yep, makes sense.
And I'm happy to answer any questions if you have companies or clients that ever want to chat. I'm always available, to chat.
Yeah. Well, look, I appreciate it. Thanks again for joining us.
Yeah, it's my pleasure. Thanks for having me, and have a great weekend.